3rd, 2023. I want to talk a little bit about trap traders. So on bar 45, you can see that. Imagine if you sold above bar 45. So bar 45 is a small bear bar, and traders, generally bears, will sell above bear bars. And so if you're a bear and you sold above bar 45, think about how disappointed you are in 46. If you sold above 45, 46 is pretty much the worst possible bar that you could have possibly seen. And so you're probably extremely disappointed and want to get out at break even if you could. And you can see it gives those traders the opportunity to get out at break even on bar 59. It trades exactly down to, one tick past the 45 high where traders can buy. And you can see those traders were buying back shorts. Bulls know they were buying back shorts. And so bulls will buy. You can see the bulls that buy, but got basically exactly a 5-point scalp. And when they got their 5-point scalp, they exited. And that's pretty common in a lot of areas. I show that kind of stuff as much as possible on these reviews. But something else that's important to keep in mind is what the other side is doing. And so, like, for example, here, if you sold above this, it's going up, but you're thinking about what bears are doing. And it's the same thing in here. It's hard to get long in this, but, where did bears make money? Bears didn't make money selling here. Bears didn't make money selling below 10. Maybe like 2 ticks, but that's not enough to justify saying bears made money. Bears weren't able to make money anywhere until bar 25. You can see on 25, they got pretty much exactly a 1-to-1 down. And it's the first time we've had 3 straight bear closes today. And so now when you get 25, 26, 27, you know that bears have made money. And so the market is theoretically should go more sideways after bears make money. And you can see it started to, because when you get these, you know that traders who sell above will probably end up making money. And so a lot of bulls who are long for any reason are selling out above 25, expecting that we're going to pull back, and bears will sell above it, trying to make at least a scalp. On these types of days, it's okay to enter breakouts. So just try to, again, thinking about the other side, try to think about if you were just trying to sell any bar, if you were to sell below any bar, and it's pretty much okay to buy above those bars so long as the bears aren't making money. So, and some bear might try to sell below 12. It's a double top, potential wedge. And when they get filled on 14, where is their stop? Their stop is above 12. And so if you buy right where bears are getting stopped out, those bears are getting stopped out and they're buying back shorts. So if bears are buying, then bulls are going to buy. And if bulls and bears are buying, you probably want to be one of those traders buying. And it's not as good of an idea here because you can see that bears made money, but bears aren't making money here. So it's okay to take those breakout trades. And, you could buy above 41, arguing that we're probably still in a small pullback bull trend because this pullback, it was a pullback, but it was sideways. And we haven't gone below the moving average yet today. Generally, when you go below the moving average, there's a 60 to 70% chance that you're going to retest the new high. So, even if you buy this breakout and immediately pull back, you're probably going to get another bounce. And that's something that actually happened today. You can see that we bounced after, we're here now. So we're 44.75. We're way up here right now after Globex. There was a huge rally for whatever reason. It was probably actually a vacuum test of this low, the 811 low. You can see it was 44.59 and we didn't quite get there today. And that was an important price because traders bought below, they bought the breakout and they were never let out. Or you could argue that they bought, the 814 breakout. Either one is fine. But these are both magnets and traders bought below them and they were never let out during any of these bars. And so, if you bought below here, how disappointed are you in this? Very. So they're looking to get out around break even if they can. And sometimes the market will race up to those profit targets. So yeah, but you could buy that breakout, you could have bought above 4, that'd be super aggressive, but you could buy the close of 6, buy the close of 7. But on these days, it's okay to buy breakouts. I had another example that I meant to show. Small pullback bull trends. July 18th, similar thing. We had trap traders. We'll actually want to go over that first. So we have open gaps on this day. This is how I see them at least. Any bear who sold above bar 4 trying to, scale in higher and make money really wasn't able to. You could argue that if you sold above 4 and you could get out during 7, but that's really hard to do. So very, very few bears were able to make money here, and the vast majority of bears got trapped. And you can see on bar 12, bears tried to sell above again to make money, and they got trapped below 20. I think it dropped below 20. They got trapped on 15 and 16, and they were never able to get out around break even. when you get two open gaps early in the day, you have two sets of trapped traders. Those traders are most likely going to stay trapped, and you might have a trend in that direction. And similarly here, you can see bears who sold above 2, not let out during 5, and this was a 50% pullback of the spike. This day is July 18th, 2023. And so bears who sold above here were not let out during 5. Bears who sold above bar 4 were not let out during 13. So you have two sets of trap traders, and you could buy the breakout here. You get follow through. You could buy above 21. You get follow through. You exit below the double top. You could buy above 29 once it reaches up there. You get follow through. So it's just another example. These are other examples of, we still had trap traders in these. You can see we still had open gaps, but these days traded differently. It's a parabolic wedge up, and it failed. And then, potentially buy above here, hoping we get a measure move up. This one, we had traders. If you can see that there's a bad signal bar above 9. This was June 27th. There's a bad signal bar above 9. Traders who sold above 9 were, expecting to be able to get back to that high. Same way that traders who sold above this were expecting to be able to get back to that high, but we never got back to it, and they got trapped. So traders will buy back shorts. So bar 1, big bull bar, tail on the top though, and bar 2 is an inside bar. It is a gap up, so slightly increased chance of trend day. But when you get an inside bar on bar 3, it's a triangle on a smaller time frame. So inside patterns are triangles on smaller time frames. You really don't usually get IIs on the open, especially immediately on the open. When you do, it's a low probability trade. Maybe a 30% chance that we've seen the low of the day by the time you buy above 3. But if 3 times out of 10, you're going to make 30 plus points, and the other 7 times you're going to lose 6 points. So 6 times 7 is 42. And then, say you make 30 points on the 3 times, you might even make more. But 30 points, it's 90. So you're netting like 45 points. So it's okay to take the buy above 3, hoping that we break out. And if you look, bears never even got a bar to trade below a prior bar until bar 10. So it was a bull micro channel all the way up here. So pretty reasonable to buy on the open, especially when, traders haven't had a bar trade below another bar. 4, it's follow through, but it's probably not the follow through you want. It does close above 1, which is good for the bulls, but bulls wanted, much better close here. So you get disappointing follow through on 5, as a lot of bulls who bought 3 will be exiting during 4. Disappointed, maybe take a 5-point scalp. 6, follow through for the bulls, big bull bar closing, above its midpoint, but it's the top of a tight channel. You can see. So it's lower probability to be long. Want to wait for more follow through, which you do get during 7. Good bull bar, but again, not closing near its high. 8 and 9, kind of similar problems. They have tails on the top and they have tails on the bottom, which means that we're probably going to pull back soon. This whole day kind of felt like it was probably going to pull back soon, which is pretty common on days that just go the whole time, because it leaves traders thinking that they can keep waiting, or they should wait for the pullback, and then it never comes and they get trapped out and they chase the market up. And with the bulls continuing to buy, that's how it continues up. 10, bar finally trades below another bar on 9. This was strong enough for a second leg up though, so any bull who bought above 9 during 10, disappointed in 10, probably uses 12 to get out around break even. 11's a high 1, but we're probably going to go more sideways. 12 is a double top of 10, a potential swing short, but do you really want to take that? You're in a tight trading range. This is pretty strong. We're probably not going much lower if we do go lower at all. 13, inside bar, probably buyers below, probably sellers above. You can see we did end up finding buyers below. It's a wedge pullback, 10, 12, 14. And it's sideways, which is something to note. 5 bars and completely sideways. So bears can't get any consecutive bars. The pullback isn't really down. It's completely sideways. So those are both signs of strength for the bulls. And we end up getting a surprise breakout on 15 and surprise follow through on 16. 15 and 16 is good enough for a second leg. So a lot of bulls will just buy the close of 16, expecting that we're going to get at least one more leg up. 17, bad follow through for 16 bulls who bought above 16. Most likely we're going to continue sideways to up for a couple more legs, because 15 and 16 are really strong. And you could argue that 15 and 16 resets the count. So we might have had 1, 2, 3 somewhere in here, some sort of wedge, and a potential breakout above the wedge. So you could argue, 40% chance of a measured move up. And some traders will do that and they'll buy 16 close hoping for that measured move. And if they get bad follow through, they'll exit. 18, probably sellers above 17. Maybe some bulls who bought the close 16, disappointed 17, exit during 18. But if you buy 16, you probably know you have to sit through a pullback. 19, this is an expanding triangle essentially on a smaller time frame. 19 outside down. And why is it important that it's an expanding triangle, right? So expanding triangles often have 4 or 5 points, or 3 to 5 points, and then they get a breakout. And you can see we had, you had 1, 2, 3 points here, and then a breakout above, which is pretty common. 20, high 2, maybe you could buy above, but it's probably going to be more sideways still. The majority of the day, it was probably going to be more sideways. It just never ended up really going sideways. But again, bears aren't making money. Bulls are. So do you really want to sell? No, you just want to buy. Follow through 21. Bad follow through for 21 on 22. So probably, like I said, probably sellers above 21 because we didn't close at a new high. And second leg up from 20 and 21 on 23 and 24. But sellers at the new high. So not all that good. 26 potential place for the bears to make money, and you can see, 25 potentially bears will make money. It's 2 legs up. You could argue it's a spike in a channel. So spike 15, 16, channel 18, 21, 22, 23, 20, 20, 21, 23, 24. So it's essentially a spike and then 3 pushes up in the channel. And then some bears will sell below 25, hoping they make money. You can see bears make a scalp. And it's a 2-legged correction, 25 and then 26, down on 26, up on 26, down on 27. So it's a 2-legged correction on a smaller time frame. Some bulls will buy the close of 27 because we haven't had a close below the moving average yet today. And bears need one more bar to flip the market to always in short. And so they're not going to, the most likely scenario, since bears haven't really been able to make money generally, is they're not going to get that extra bar to make the market always in short. That's kind of what happens on 42. Some bulls will buy the close of 42, expecting that 43 is not going to be a big bear bar, and that bears will be disappointed, and that's a pretty good bet. And so they take that buy, and that's what causes 43 and 44. But anyways, bulls buy the close of 27, trying not to let it trigger, trying to prevent a bear bar, and they're able to. 29, bull bar, testing the 24 close, and good follow through, or not very good follow through on 30, probably sellers above. It's 3 straight bull bars, so it's probably enough for a second leg, but probably sellers above here, probably going to test a little bit lower. You can see any bear who sold above 28, skilled in a new high, made money on 31. You don't want to sell 31 though, this is too strong. 32, bad follow through. You can see 33, potential second leg up for bulls. We're probably going to at least test the 30 close. 34, test the 32 close. So bears who sold the close at 32 for, maybe hoping we test 25, maybe hoping this is enough for a second leg. Disappointed 33 and exit during 34, and that is the second leg. Sellers above 35, or sellers above 34 during 35, inside bar 36, outside up 37. It's still technically, we're still trending higher. We still have, we've had, this is a higher low, this is a higher high, this is a higher low, this is a higher high, this is a higher low, this is a higher high. This is a higher low, and then we got a higher high. So as long as you have trending higher lows and higher highs, it's still a bull trend. You could argue it's a pullback in the bull trend, which it probably is, but as long as you have trending higher lows and trending higher highs, it's still a bull trend. Versus here, you can see we ended up getting, you could argue that this is the higher, we got a higher low here, so it's probably a trading range, first off. But you could argue that this pullback, this could have been essentially a major higher low, and we fell below it, since 46 was an important support point. And you could argue consecutive buy climaxes, maybe 1, 2, 3, and we usually fall below the third climax. But anyways, 38 follow through, 39 follow through, 40 follow through, 3 bull bars, but they're not very big. So it's not ideal to be buying here. 39 and 40 do close at a new high, but I'm not so sure that I want to be buying, because we're probably going to pull back. Though it is okay to be buying because, like I said, it is higher trending higher lows and higher highs. It's just not maybe ideal. So because you might have to sit through a pullback like 41 and 42. And if you're not capable of just staring at 42 and knowing you probably have to buy that close rather than sell it, probably shouldn't be buying here. 43, like I said, bulls buy the close of 42, trying to prevent a bear bar. Bears need one more bar and they don't get it. Fall through 44. It's a pair of bull bars, probably enough for a second leg, but we didn't quite close at a new high. But it's definitely okay to be long. Some bulls buy the breakout above 41, like I was saying, and those trending higher lows and higher highs, as long as they're getting that, they'll be buying breakouts. 45, doji bar, probably going at least a little bit higher, but I'd be unsure after this doji. And then bull surprise on 46. 46 is a climactic bar, closing near its high. And some traders will see this as a place to take profits, and some bears will sell. But what's really in it for bears here for selling? They've made money on a stop order once today, one time, and they made a scalp. Bulls have made, well, you could have bought, you could have blindly bought any bar today and you would have made money. Pretty much, at least up to this point, you could have just blindly clicked buy the market at like any time. And if you held for a couple bars, you were going to make money. So really what's in it for bears for selling the 46 close? It's just not a good idea. You got to think about the other side. What are they getting out of it? And really not very much. So we're probably going at least a little bit higher. 47, follow through for bulls, but not that good. 48, inside bar. Again, it's potentially some sort of triangle. Inside bars are triangles on smaller time frames. 50% chance the first breakout fails. But this, if you bought above 46, you want the market to keep racing up in a very parabolic way. You're just not getting that on 47 and 48. 46, generally 60% chance it's a buy climax, and towards the end of the trend, 60% chance you get one more leg up. Pull back 50, and then you get another leg up. 51, 52, probably buyers below 49. And then you can see there were sellers at the new high, knowing that this was a climax and probably 60% chance we were going to go sideways to down. 54, inside bar, probably buyers below. 55, probably buyers below. And you can see when those traders got trapped, they weren't let out at break even until later in the day during 75. 56, follow through, potential short to the moving average, but I don't want to sell. You just shouldn't sell on a day like this ever. It's just not a good idea. You might eventually make a little bit of money, but if you're selling 56, you probably took a bunch of other sells and lost a bunch of money. 57, follow through for bears, and 58. 4 straight bear bars is a pretty tight channel, so enough for a second leg. 59, bull reversal. Like I said, it's at the 45 high where there would probably be buyers, but this is a pretty tight bear channel, and we're probably going to get at least one more leg down. It is true that we've been above the moving average all day, so bulls will probably buy the first test of the moving average, but I think that this is steep enough that you should probably just wait and see what happens. If you get follow through on 60, like a bull bar, you could buy it, trying to scalp it up to a new high. Bad follow through 60. 60 is a low one short in a tight bear channel. Maybe we're going a little lower, but probably not too much lower considering how the day has traded so far. I think the best case scenario for bears is they got back to the 42 close, and then we formed some sort of double bottom. We just ended up forming it higher. 61, 62, follow through for bears. But, I don't think we're going that much lower. I don't know if it was leg 1, leg 2. Let's see. Not really. I mean, I suppose it was. I'm sure I could find one. I'm sure there's one in here somewhere that I'm just not quite seeing. It's not, I guess, you could argue that's it right there. Leg 1, pull back, leg 2 subdivides into 2 legs. But it's not that important to pay attention to measured moves on days like this. I think it's more important to just find ways to get long. 63, inside bar. We're probably getting back to the 60 low, considering some bulls will buy below there betting against follow through. So 64, again, not quite what bulls want. Bulls are looking for a gap bar, basically a bar. We're below the moving average, and we haven't been in 60-ish bar or 57 bars at least. So bulls are looking to buy a bull bar closing near its high to get a swing up. The problem is this was a relatively tight channel, so you don't want to buy 59. You want to wait for a second leg down, which we got. So some bulls will buy above 59. But I think if you're buying above 59, you have to have a wide stop. A lot of times the market's going to race down and try and test the 62 low. But you have to keep in mind that 63, 64, and 65 is enough for a second leg for the bulls. So even if we do get down here, there's probably buyers. So if you're buying, you probably got to have a stop like at least down here and be buying more here. I'd probably have an even wider stop because we could definitely test down here, but I don't think we should test past that. So probably gonna stop somewhere down here and be buying more here. And if you get a strong bear close, you just get out. But bulls bought more below 62. We got a reversal up on 67. Maybe okay to buy above 67, but if you're buying above 67, you want the same kind of follow through that bulls who bought above 46 wanted. You want a pretty parabolic move, probably up towards a new high, and just take your profits there. Because why? Because the risk is big. So when the risk is big, you want really fast follow through. And you can see a 2-to-1 of your risk reward is up here. Maybe we get there 40% of the time before we get down here, but it's really not that good of a trade to be buying up there if you don't get fast follow through. So when you get a bit disappointing follow through on 68, maybe some bulls stay long, but more disappointment 69. And you can see we started to race up and then bulls just scalped out above 68 after 69, knowing it's probably just a second leg from 67 to 68. Probably buyers below 70, but it's pretty late in the day. And one of the reasons why it's hard to stay long on bars like this is you have to keep in mind that we're in a trading range now. So buying above 67, this kind of follow through can often lead to a deep pullback. In trading ranges, pullbacks are generally very deep. And so, holding for another leg up, maybe you'll get a little bit more profit. But the problem is a lot of times you're going to get big bars like 77, and that just remove all of your profit in anything, and force you to take a loss. Here, you would have gotten lucky and you would have been able to stay in, but a lot of times it'll trade down, stop you out, and then reverse back up. So I think that if you're buying above this, you probably just have to scalp out somewhere in here. On the daily chart, it's 2 legs up to, resistance. I think we're probably going to be pretty sideways tomorrow. It's low probability that we just get a big bull bar. This kind of bounce was expected. If you look at the weekly chart, where are the trap traders? Right here. There's trap traders below 724. I don't necessarily think we're going straight up there. We might, but it's very possible we get a 2-legged correction up to around this low and then a lower high major trend reversal. The way to look at it, I'm going to look at it at least, is trend line break, lower high, major trend reversal, potential swing down. For always in, I think it was always in long from the gap. But if it wasn't, maybe by the close of 4, always in long, probably always in long by 6 or 7 for sure. And bears, if they had gotten one more bear bar on 28, it would have been always in short, but they didn't get it. If bears had gotten, maybe one more bull bar on 33, maybe it's always in short, but they didn't get it. 43, if they got one more bar, it's always in short, they didn't get it. And you can fade these always in flips on trend days. 57, probably always in short on 57, and maybe back to always in long. Probably not by 65, maybe, but probably not. And I think by 67, it's back to always in long. And then that was pretty much it. The market cycle, this is important. We were in a tight bull channel to start the day, and then in a broader bull channel, and then we got a breakout, which is unusual. Usually it's, a breakout and then a tight channel and then a broad channel and then a trading range. That's usually how the market cycle goes from strongest to weakest. But today it was traded a little bit differently. And these tight channels are broader channels on smaller time frames, which makes it less likely that we're going to go up as fast as, or go up like we did. But like I said, bears aren't able to make money. So it's important. But anyways, that's it for the day.